market cap weighted indexes are backward looking. And as you go forward and these sectors grow, their footprint in the S&P 500 and in major market indexes as a result of relatively strong earnings growth and their relative import to the infrastructure development, the market cap weighted index will eventually catch up.
All right, joining me will be Andrew Chanin, CEO of ProcureAM, who's behind the Procure Space ETF, ticker symbol UFO, which that's got to be a top 10 ticker symbol of all time. But this ETF has garnered a lot of investor interest recently. As a matter of fact, just over the past year, listen to this, UFO has gone from about $50 million in assets to over $800 million in assets just over the past year. And along with that, it's had exceptional performance, which obviously that never hurts. So if you look, UFO is up nearly 150% over the same time period, 150%. And so Andrew and I are going to discuss that investor interest and performance. We'll, of course, dive into the ETF itself, which this is index-based. And the index it tracks recently updated its methodology to fast track big IPOs like SpaceX. So we'll certainly talk about that. And then we'll also get into the broader investment opportunity around the entire space theme. This should be an excellent conversation. Now, later, I'll be joined by Paul Baiocchi, head of fund sales and strategy at SS&C ALPS Advisors, who currently offers 26 ETFs, nearly $22 billion in assets. And we're going to spend some time diving into the AI trade, the artificial intelligence trade, but maybe not quite in the way that you expect, because we are going to look at several sectors or areas that AI is impacting that Paul believes might be flying under the radar of investors. And so because of that, these are areas that are underrepresented in portfolios. So this includes materials, energy, data center REITs, those sorts of areas. And the point is that AI is becoming much more than just NVIDIA and some of the other Mag 7 companies. And so Paul will explain why he thinks investors should be paying much more attention to all of this. And we'll walk through several relevant ALPS ETFs. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. Okay, so let me first welcome in Andrew Chanin, CEO of ProcureAM, who's joining me from New Jersey. Andrew, it is so great to have you back on here. It's been a while.
It's always fun to be on the show. Thanks for having me.
All right, so let's start with that interest around the Procure Space ETF. As I just mentioned, ISO assets have gone from about 50 million to over 800 million just over the past year. And a lot of that interest, if you look, has come here recently, I would say, especially over the past month or two. And so to start, I'd love to have you talk about that. What do you think's been going on here with that huge uptick in interest?
So these are all themes and parts of what we've been talking about for years now about why space is at this inflection point and the opportunities that that's presenting, not just for these space companies that are focused pure play space companies, but for more terrestrial types of companies that are also interested in expanding their business and enhancing their capabilities by utilizing space. And so if you go back 7 years to when we launched the fund, we were talking about things like reusable rockets, significantly reducing the cost of accessing space. And while SpaceX was the pioneer for that, many other companies are beneficiaries of this significantly reduced cost, which makes many other types of technologies potentially economically feasible that wouldn't have been otherwise. Other themes like the militarization of space really started to catch on at the early days of the Russian-Ukrainian conflict, when you started to see a company called Maxar, which has been taken private, was showing up-to-date footage of buildup and imagery on the Russian-Ukrainian border of troops and supplies. And so through these various things that have happened year after year for the space industry, we're starting to see a ton of attention, and most notably recently, the excitement around the upcoming potential SpaceX IPO.
Yeah, and clearly one thing that's helped here in terms of the interest in the ETF has been performance. Again, I show UFO is up nearly 150% over the past year. Can you talk more about some of the drivers of that just at a high level? You just hit on kind of what's happened over the past 6 or 7 years. Has that been what's been the performance driver, or is there more to that here recently?
So, over the previous several years, there were a lot of headwinds. And this was kind of the unwind of the SPAC bubble that people refer to, where many space companies that were coming publicly to the market over those several years were coming to the market via SPACs. And I think people had to take a pause and realize, okay, some of these deals weren't necessarily the best. Some of them weren't the best for the companies. Some of them weren't the best for the end investors. And now, a lot of them kind of all got punished with the same baby with the bathwater mentality. And several years after that shakeout, you're starting to see some of these companies emerging on better footing. So some of these names that I think were maybe harmed a little bit more, people realize, hey, some of these companies might be here to stay, and they might have a little bit of a stronger foundation that we may have anticipated, and they're starting to be repriced. You also have competitors to Elon Musk, like Sam Altman, who came out towards the end of last year saying, I want to create a rival to SpaceX. Certainly a very ambitious claim, but the way that he said he hoped to do so was by either building his own capabilities, partnering with existing companies, or acquiring them. And whenever you start to hear about people talking about making acquisitions, many people start to play the multiple game and what other companies are next in the market cap game. And hey, if this company is worth this much, maybe this one should be worth a little bit more. And people start to focus on these companies. You also have, around the world, you have research houses and banks starting to be built up with a focus on space. This is no longer at every major investment house just kind of a fringe part of a broader technology, or hey, we're looking at deep tech, or companies like Tesla also falling into the same analysts covering the space industry. You're getting actual teams that are focusing on many of these companies, and people are starting to unlock and realize what some of the value opportunities for some of these companies that maybe had been overlooked for many years. And that's how you have a situation like you've seen with ASTS over the last 2 years, where it went from a name that most people don't know to a name that is probably one of the most popular kind of retail trading space names out there today.
When you think about how much the industry has changed over the past 7 years or so, and some of the evolution you just described, you did launch this ETF back in 2019, which, by the way, I'm not sure if you remember, you actually joined me on here shortly after that. I always remember that because this was such a unique launch, and you had the UFO ticker symbol. It was just a good story. But I think at one point in 2021, Andrew, assets in the ETF were around 140 million, which is pretty darn good. But then they came back down to around 30 million in 2024. I think with some of the challenges you were describing earlier, just in the space overall. And I'm curious if you ever had doubts that this ETF would succeed. Like, was it difficult for you to stick with this through some of the lower points over the past 7 years?
I've had tremendous conviction with this theme. When we first launched our company, ProcureAM, we wanted to launch with a fund that we thought was a long-term theme. And we really believed in the space industry. We really believed in our partners, the index that we licensed. There was a lot of back and forth beating up the index until it looked like something that we kind of really believed in would have the ability to not just capture what the current landscape of the space economy looked like, but also what that future landscape might look like, and have that ability to kind of adapt as the industry itself changes and grows. And so space was something that we truly believed in. I certainly have seen my fair share of naysayers and doubters on this theme, from major research houses to just individual people on the internet not believing in space or saying it's too early. But we really saw these transformational changes and this inflection point that was happening with this industry. And we said, we think people do want to invest in this. And certainly, similar to every other industry out there, expect volatility. But because of that, that might be a reason that people might want to utilize an ETF structure to get diversification. And in our case, global diversification to many companies from around the world specializing in these various areas. So certainly has not been a straight line path, and a lot of people are celebrating us as a 7-year overnight success. But this was something that we really believed in, and we've actually built out a really strong presence and relationship across the space industry, not just from even the investing side, but we've even through some of our other affiliates have worked with early stage private companies that are doing some unbelievable work for the space industry, and we're excited to see what those breakthroughs can have as well. So this is something that we believe in. We weren't discouraged. Certainly, we were wondering why no one else was seeing this opportunity, or why not everyone else was agreeing that hey, this was something that they might want to be in. But certainly, it's been great to see people start to catch on recently, and many of these trends that we expected to happen are playing out right in front of us today, which is really encouraging.
Well, I love the conviction that you have had in sticking with this because, as you know, if you look at the ETF space historically, there are so many examples where there are very innovative ideas, great ideas that come to market, and there's not initial investor interest. And ultimately, the ETF issuer decides to shut the ETF down. And a lot of times that happens right before that particular theme may go on a run. And it's easy for me to say, I'm not an ETF issuer. I know the blood, sweat, and tears that it takes for ETF issuers to put into their ideas and make them a success. So again, credit to you for sticking with it. And now everything's coming to fruition here as the space category really takes off, no pun intended. You mentioned that the ETF is index based. Why don't we talk about the ETF itself, and then we can come back to the overall investment opportunity in the space category. And I saw that this index recently rebranded, by the way. It's now the VettaFi Space Index, if I'm not mistaken. But explain what's going on underneath the space shuttle hood, if you will. I apologize.
Yeah, so a lot of the team behind the index remains. VettaFi acquired S Network. They kept the name S Network Space Index for years, but officially on May 15th, the index will rebrand. It is also making several changes. But one of the things that really excited us about working with S Network and VettaFi in the early days was they were working with a consultant, a former director of research for the Space Foundation, Michael Walter Range, who actually helped develop what is probably the most tracked and quoted space report on an annual basis, the Space Report, which he actually built out the model that's used today and across research houses around the world for defining and calculating the size and growth of the global space economy. And so he's over there helping them build out the universe of what space companies are, actually doing the research to determine percentage of revenues derived from space, which is very important to us. We didn't want to create a space fund and have it completely moved by companies that are much larger, diversified companies where space is just such a tiny part, and all of a sudden the fund's going up or down based on something that has nothing to do with space. And so when you look at the index, it focuses on at rebalance time up to 80%. Or at least 80% of the index needs to go in these pure play space companies. So companies that are deriving at least 50% of their revenues from space related businesses, activities, and services, while also recognizing that the diversified global aerospace and defense names can also be major players in this industry. But because space might not be the primary part of their revenue driver, not wanting those names to completely overweight based on market cap. So up to 20% of the index at rebalance can be focused on these more diversified aerospace and defense names. And they also have to have, a certain minimum of annual revenues from space, or a certain percentage of certain amount of revenues or percentage of revenues from space. But this recent change that the index company is going to be implementing effective May 15th is this mega cap IPO rule, which will essentially allow an upcoming pure play mega cap, by their definition, space company, to the day after the IPO price is calculated, to be included into the index, which is something that you're seeing kind of around the world at index providers looking to take into account this new reality of these much larger companies coming into IPO at a later stage of their development, and wanting to find a way for them to have a presence. And so this is something that VettaFi didn't overlook, and companies like NASDAQ and others around the world are also looking at similar types of fast track inclusions.
Yeah, so obviously with that fast track methodology, the big company that everybody's talking about is SpaceX right now, which is obviously highly relevant to your ETF. How big of a deal do you think that SpaceX IPO is? And I'm not asking you for a price target or anything like that, but what is the significance of a company such as SpaceX coming to market?
Yeah, this is a tremendous signal. For years, I think there's been many entrepreneurs out there that have looked at the space industry and wondered, hey, should I go forward with a company or technology in this area? And many might have seen this as something that maybe doesn't get as rewarded as breakthrough technologies for other industries. And seeing that potentially the largest IPO in human history might be this potentially pure play space company, I think is completely eye opening for entrepreneurs, for students today, for people in the sciences that are trying to figure out what to do with their careers. And seeing that these companies can be rewarded with these tremendous valuations is something that could have potential benefits for many years for this industry. And the amount of focus and media attention and coverage that will fall onto the space industry with something like such a large company coming to market is something that I think as a country we should be celebrating. As humanity, I think we should be celebrating, because many of the goals of SpaceX are going to further potentially help benefit humanity's cause and the way that we view collaboration, the world, and our own human ingenuity and capability. So I think this is certainly a tremendous happening where we'll be thrilled to see a publicly traded SpaceX. I think for people that want more transparency, or people that have questions about government contracts to SpaceX or why they're getting them, I think this is going to kind of increase the stakeholder reach, where retail investors, institutional investors will for once be able to get much easier access and direct exposure to this company than previously as a private company.
As it pertains to the ETF space, one thing that I've noticed with this forthcoming SpaceX IPO, and I'm 100% sure you've noticed this too, is there have been a number of competing ETFs launched in the space theme category, and there are more on the way. If you look at SEC filings, and I do think a big part of that is issuers simply trying to pre-position ahead of the SpaceX IPO, because it is going to get so much attention. It is such a big deal. And, I think the simple thought here is that this category overall is going to attract a lot of investor eyeballs. I'm curious how you think about the competitive environment in this category right now. As we discussed, obviously you were very early here, but what do you think about all of these new entrants?
So the ETF industry is certainly littered with thought laggards when it comes to thematic ETFs or jumping on themes after someone else. I'm certainly no stranger to having seen it happen many a times with my first company, Pure Funds, where we sponsored the first cybersecurity ETF in the world, and many other first to market ideas. So for me, being first to market, recognizing what these potentially in demand themes are, and being able to provide exposure to it in a way that isn't just a flash in the pan kind of industry is something that I think I've built an entire career around, and people know us for and expect from us. And so, this to me is just further confirmation that we came out with an idea that we thought that people would have demand for. And so, seeing that is no surprise. It's just certainly more validation in the concept in our mind, but wasn't unexpected. So, people are coming out with different approaches. Certainly we have, a track record that extends longer than 7 years. It's funny, I see, some companies that are bringing these, rival products out, within the last month or so, and they're promoting them as, we believe now is the time to invest in space. Well, look back 2 years ago when a company like AST Space Mobile wasn't a household name and was trading at, roughly 250 or less. And you'll look at these, tremendous opportunities in the space industry that these companies missed, and they didn't realize potentially when might be a good time to bring these products out for investors. So, I think that this is something that, I think, we're really happy for the space industry to see that there's so much attention to it. But then you also see companies trying to get clever and do things like sneaking in, SPVs and things like that. And I don't know if investors really truly understand, the full risks there. I mean, what happens when you've got a fund that has a very large concentration in an illiquid SPV that potentially has a 6-month lockup? And now you've got a fund that's out there with a illiquid position, potentially in SpaceX, versus other companies that are carrying SpaceX without potentially a management fee attached to an SPV, or what other fees might be there as well. And what if the SpaceX IPO isn't, absolutely tremendous and people lose interest in space? Well, if you can't sell an illiquid security, what happens to a fund that's at 10, 15, 20% when they can't sell this illiquid asset? What happens with that SpaceX percentage weighting in their fund? So I think there's a lot of things out there that investors need to consider. I think having a long track record where people can look at what has this done during different time periods might be helpful. Obviously, past performance, you shouldn't expect that to necessarily repeat. But I think that hopefully people will see confidence in working with us and realizing that we're not just here because something's hot, but we're here because we truly believe in the idea, and we work with industry partners that also understand and believe in this industry.
You mentioned that longer term track record. If I'm not mistaken, I believe most, if not all, of the recent space ETF launches are actively managed, which again, as we were talking about earlier, UFO is index based. Can you talk a little bit more about what you see as the value of that being index based? Because that's clearly a differentiator here when investors go and look under the hood of these ETFs.
Yeah, we're not trying to be cute. We're not trying to make the argument that any company in the world is a space company, because you could make that argument. It's very easy nowadays to find some tangential way that space is affecting almost every publicly traded company out in the marketplace. And I think that many index providers or active managers, do have an approach where they say, okay, let's make an argument for how this could be a space company because we want to squeeze this into this fund. And, that's going to come down to every other, investor having to determine, what is the track record of these active strategies? There was an active fund by Cathie Wood in the space industry years ago. How has that played out historically? That's probably one benchmark that people could look at as, an active approach at space and how that's held up over the years. But what is the actual track record of these portfolio managers? What understanding do they have of space? How much focus do they have on space? Or are they generalists? All of these things come into play when an advisor is having to do research to find the best fund for their client to be in. And if a portfolio manager doesn't necessarily have specific space track record, what are they giving you? You're certainly taking a leap of faith that they're going to capture that theme in the way that you expect. And for us, again, at the early days of licensing this index, it was kind of putting ourselves in the shoes of a long-term investor and saying, if I was to own something that calls itself a space fund, am I getting an exposure that I would actually, expect or close to that? And so by having this firm, set of rules, not getting cute and picking favorites, but sticking to those rules, that's something that I think investors can look at and have a better understanding long-term of what they may be getting themselves into.
In terms of exposure, if I look at top holdings in UFO right now, I see companies like Rocket Lab, Planet Labs, Viasat, Global Star, MDA Space. Do you maybe want to pick one of those companies and just give people a feel for what that company does and why they are included in the ETF?
Sure. I mean, just going through that list, some of these might have overlap with other funds now that are Johnny come latelys to the space ETF industry. But sure, let's go with Rocket Lab. As of last night's close, it's the largest holding. They have the Electron rockets that have been very reliable. Their track record of successful launches has been nothing but impressive, and shareholders have rewarded that. Coming from their post IPO going under $10 a share, several years ago. Now, certainly a household name. People look at it as a rival in the launch industry compared to SpaceX. So they're building out their next gen rocket, Neutron, which they're hoping to possibly test later this year, which will allow this company to take on clients with larger payload requirements. But they haven't necessarily, proven that they can absolutely do that with this new rocket ship. But, launch is something that's really important. You talk about these massive satellite constellations and how they need to send up thousands to tens of thousands of satellites to make these constellations fully effective. Well, what do you need to get satellites into space? You need launch capabilities. And so as we saw with AST Space Mobile just a few weeks back, Blue Origin's New Glenn failed to actually get their satellite into the correct orbit, and that was a loss. And so, there's only so many launch companies. If there's a huge demand to get satellites into low Earth orbit or for other missions, there's a huge amount of demand and not necessarily as much of a supply ability for this. So companies that are successful in this area could command a lot of demand for launch services. And Rocket Lab is one of those potential companies that are leading the way there.
Coming back to the overall investment opportunity here, I think you've done a good job of outlining the space overall, but let's put aside the SpaceX story. I think we all agree there's going to be a lot of buzz around that. That's going to get a lot of attention, as we talked about earlier. But what are some other potential drivers of the space category overall? Like what are you most watching moving forward?
So the militarization of space is something that I think people weren't expecting to come on as quickly. Space is now viewed by militaries around the world as strategic high ground. The Ukrainian-Russian conflict made countries, companies reconsider who they partner with, which companies they work with, which governments they feel safe working with companies from those jurisdictions. And do we have a sustainable future? And so for space dominance, or do we need to rely upon an ally, or do we need to just hope and pray that someone is going to be there to service us in ways that we need as a country? And so the U.S. has been absolutely a leader in being able to build out their own capabilities. China is also looking to do many things. They have their own orbiting space station. There are many things that these various countries and companies are looking to do. And what we'll see is who these winners are, but they're putting in tremendous amounts of investment today to build out that infrastructure. And those companies and countries that are the winners of this decade could have potential tailwinds for years to come, utilizing that infrastructure for future clients and other spacefaring nations in the future. So there's a lot of potential drivers. The militarization and defense of space has been one. Certainly data centers in space are getting a lot of attention in the short term right now as well. So there's a lot. There's the moon and Artemis and these projects. So I think we could probably do a whole segment on just covering some of these areas to look forward to the future. And I certainly hope that we have the ability to do that soon.
All right, before I let you go, though, on this note, I have to ask you about the entire UFO story. You have the ticker UFO, so this should be right in your wheelhouse. And this is another area that's been getting a lot more attention recently. Of course, just last week, we saw the government release a bunch of files on this. I was out poking around on the website. It was pretty interesting. But this is something the Trump administration has said they're committed to doing. So I'm assuming you view this as a positive for the space category overall, or what's the takeaway here?
We've taken this topic very seriously since our early days. To my knowledge, we are the first publicly traded vehicle in the US that's actually put a UAP risk disclosure into our fund's prospectus, and we did that many years ago. So this is an area that we do look at, and we do take it seriously. In my mind, if aliens are real, there's a couple things that could happen. We're either going to unite as a world potentially and put a lot of effort and collaboration into building capabilities to protect ourselves and defend ourselves, which could potentially be a driver for space. Or potentially this could be friendly and non-adversarial. And what if there are non-adversarial life out there that want to collaborate with us? Well, what could we do with having technology that could potentially leapfrog our own capabilities? I'm seeing just from individual scientists working in small labs, some incredible technologies that most people aren't aware are even being in the process of being developed. So I come from a completely different spectrum of where I think some of these technological breakthroughs can come from, and that maybe they could happen a lot sooner than others. But we're certainly opening, we have open minds, open eyes, and we're willing to see some of these files. And hopefully this will be something that will get much more global attention and conversations going at a minimum.
What is the UAP risk disclosure? So UAP, that stands for Unidentified Aerial Phenomena, correct?
Correct.
What's the risk disclosure?
So it takes into account that the government has announced that there are these UAPs. We don't know where they're from. We don't understand the technologies, or even that they could be human created or adversarial. And that because we don't know this, they could have the ability to affect space-based capabilities or beyond, which could potentially affect markets.
I love it. A perfect spot to end our conversation. Andrew, I always enjoy connecting. Congratulations on all the success that you're having with this ETF. Again, it's certainly been extremely well earned. So congratulations on that. And thank you for joining me.
Thanks for having me. Pleasure to be on.
That was Andrew Chanin, CEO of ProcureAM.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at Vetify.com.
I'm now joined by Paul Baiocchi, head of fund sales and strategy at SS&C ALPS Advisors, who currently offers 26 ETFs, nearly $22 billion in assets. And I'll tell you, they have a very unique ETF lineup overall, including a number of ETFs around the AI trade, the artificial intelligence trade, which is what we'll be discussing this week. Paul is now joining me from Denver. Paul, it is great having you back on the podcast. How have you been?
I've been well, thanks, Nate. It's always great to see you. I'm excited to have the discussion. I always learn a little something and get to explore some topics which are near and dear to our hearts.
Well, I always learn something visiting with you. And as I mentioned, we are going to dive into this AI trade this week. And it's interesting. I was actually visiting with Vetify's Kirsten Chang last week, and we were talking about how ETF issuers are getting much more granular in product development around the AI trade. And you can clearly see it in new launches, which I know you track. So when you think about ETFs around AI infrastructure and memory chips, and you get into the energy that's required to power AI data centers, and even the real estate actually needed for the data centers themselves. And so, you know, this has quickly expanded from what was once perceived as basically a Mag 7 trade to, I think, something much more extensive. And so I thought, let's start there. How is ALPS thinking about all of this? And do you think investors are starting to better appreciate all of the growing tentacles of AI?
Yeah, so I'm going to borrow some language from Arjun Muti, who has a super spiked pod focused on energy markets and specifically oil. And one of the things he said on a recent podcast was AI is at its core software. And software in all shapes and sizes and in all forms requires hardware. And hardware requires power, and power requires natural resources, rare earths, energy commodities, copper, steel, all of the things that take this metaphysical realm and put it in the physical realm. And so when you say we're focused on AI, what we're also focused on in many ways is AI adjacencies and AI bottlenecks, because you're right, the advent of the ETF wrapper and some of the momentum more recently has allowed issuers to focus in on things like memory. There's a memory product out there that's been very popular, perhaps one of the most successful launches in ETF history. But when you zoom out to portfolio construction and the exposures people have in their typical asset allocation framework, a lot of the companies that stand to benefit from the massive capex, the ramp up in infrastructure development, and that physical realm is pockets of the market that people are that have underrepresentation. They don't have a lot of exposure to in their cap weighted view of the market. So things like materials, things like utilities, energy is certainly in that bucket, and to a degree industrial, certain pockets of the industrial sector. And so the way we're thinking about AI is it's a part of a bigger electrification theme where it's pushing up rising electricity demand. And you bring up the Mag 7, which I think is instructive, because what a lot of people see is the headlines around $800 billion in capex spending this year, $1 trillion in capex spending next year. Where's that money going? And ultimately, these are the companies that are fighting with each other to win the battle of AI supremacy, alongside, of course, some private companies who have not come to market. But importantly, you'll have a lot of exposure to those companies in your cap weighted view of the market. If you own the S&P 500, more than 50% is in consumer discretionary, comm services, and technology, which are the sectors where the Mag 7 live. And importantly, that segment of the market that stands to benefit from that capex spending, materials, utilities, and energy specifically, add up to less than 10% of the S&P 500. They add up to less than 10% of the ACWI. So naturally, in a cap-weighted view of the market, these sectors of the market are underrepresented.
When you talk about that underrepresentation in portfolios, and I think this will get us down the path towards discussing some of the ETFs that ALPS offers, and we can do that here in a moment. But let me play devil's advocate, which I think I always love to do on here. What about investors, Paul, who say, well, this is why I index? In other words, if companies or sectors deserve to be invested in, they'll ultimately find their way into the index ETFs I hold, and I'll just let those indexes do the work, which historically, that's been a pretty good bet. If you look at index performance versus active management, what would be your counter to that?
Well, I think in some ways it gets to some of the fundamental perspectives that one of the more famous ETF people in the industry going back 25, 30 years, Rob Arnott has always argued that market cap weighted indexes are backward looking. And as you go forward and these sectors grow their footprint in the S&P 500 and in major market indexes as a result of relatively strong earnings growth and their relative import to the infrastructure development, the market cap weighted index will eventually catch up. And our argument is that those weights to materials, to utilities, to energy, as evidenced by a cap weighted view of the market at this moment in time, are not representative of the important role that they will play on a go forward basis. And so, yes, cap weighted views of the market will capture their growth in the index, but a lot of the excess return potential in the companies, in the industries, in the sectors where these companies sit are not going to necessarily be captured over time by the cap weighted view of the market. And so in many ways, this is forward looking. This is taking what we believe is a secular trend of massive investment. Heck, we just spent $115 billion on the grid in 2025. And Bloomberg's NEF forecasts say we're going to be spending $100 billion on the grid alone over the course of the next 10, 15, 20 years annually, not just over that period in totality. So when you think about what the implications are of that, it means more money invested in copper, more money invested in specialty contractors and construction equipment, as well as, of course, all of the individual components, the companies who are at the heart of providing the power, providing the transmission, the generation in order to support these lofty AI ambitions, both domestically and globally for that matter.
Before we get into some specific thematic ETF options here, one other aspect I want to bring in here that I think will help set the table for us, and it's obviously not directly tied to AI, but it clearly plays a role, and that's the conflict in Iran, where we've now seen energy prices spike. And that's come at a time where there are a lot of conversations around how AI data centers will be powered and all of that. I'd love to have you talk more about this, because I do think the conflict has investors and certainly governments going, well, wait a minute, we better make sure we keep up with the AI arms race, because AI itself is obviously now tied to national security, but you need energy to do that. And so can you offer some perspective on that angle?
Yeah, so I think even prior to the beginning of the conflict on February 27th, February 28th, it was our belief that we were seeing a global arms race for access to power, access to the critical resources that are necessary to support these lofty power ambitions. It's not just about energy, it's not just about electricity, it's not just about AI, it's about the power behind all of that. And when you think about global commodities markets, we're expected to be in a deficit for copper, for example, as far as the eye can see, because we're coming out of a period of underinvestment. So you take what was already a fraught backdrop from a supply and demand perspective for these individual commodities, whether it be natural gas, crude oil, or the raw materials at the core of, say, the transmission build out, the generation build out, as well as, say, the manufacture of renewables, whether it be wind, solar, or more specifically storage, which has exploded in terms of its implementation here domestically and globally. And so you take an already fraught supply and demand dynamic and you add effectively, pardon the pun, jet fuel to that challenging backdrop. And it's our sense that as we come out of that, if there's a resolution, clean, messy, whatever it might be, one of the takeaways for countries around the world is, how do I ensure that I have access, to your point, Nate, to the raw materials, the commodities, and the power that's going to allow us to evolve our economy and to, of course, realize these lofty AI ambitions. And so what you're going to likely see is a massive amount of infrastructure investment in the Middle East to perhaps circumvent the Strait of Hormuz. You're going to likely see countries around the world investing heavily in renewable generation and nuclear power, in other forms of power generation that aren't as sensitive to this very small geographic location in the Middle East. And so the takeaway for a lot of countries is, okay, hopefully we get a resolution. Hopefully it's clean. Hopefully it allows for the strait to reopen and for urea and helium, as well as crude oil and natural gas, to move quickly through that part of the world. But absent any sort of certainty around what the future state of that looks like, we need to ensure that we're insulated somewhat from this geopolitical uncertainty. And so there's going to be an arms race in investment in supply chains and resources and stockpiling. And it's all part of a convergence of massive macroeconomic trends, now sprinkled with a little bit of geopolitical volatility as well.
Okay, so this is perfect. I think now that we have that backdrop, let's talk about several ALPS ETFs that target some of these themes that we've covered. And it was interesting as I was going through the entire ETF lineup, you actually do have a lot of ETFs that touch on what we're talking about here, which I think is a credit certainly to ALPS, but I think it also shows just how expansive the AI trade has become. And I'm going to start with the obvious one here, at least to me, and that's the ALPS Electrification Infrastructure ETF, ticker ELFY, ELFY. So this holds companies that I think could clearly benefit from growing electricity demand driven by AI. Do you want to talk a little bit about this one?
I do. And it's perhaps our favorite story to tell at the moment, because in many ways it's the core, it's the anchor of this bigger story. And I do want to just step back for a second and talk about the fact that, yes, AI data centers are in the headlines, and they're driving a significant amount of the forecasted energy demand growth that we're expected to see in the next 5, 10, 15, 20 years. They're massive demand centers for electricity, but it's also a convergence of other trends. We're trying to get people at the appliance level to move from, say, their gas stove to an induction stove, from their typical HVAC unit to a heat pump. That's marginal increases in electricity demand. We're trying to get people to switch from ICEs to EVs. We're rolling out these autonomous vehicle fleets, which of course are all EVs as well. And then we're trying to reshore a lot of those critical supply chains as well, which means more factories, more supply chain, and more components being plugged into the system, which, by the way, a lot of those facilities are likely to be automated with robotics. And then, by the way, Nate, you and I are supposedly going to have robots in our homes, which are also going to have to be plugged into the grid. So it's a convergence of demand sources, which is creating an increase in electricity demand we haven't seen in 50, 60, 70 years. And so ELFY was designed by a guy at Ladenburg Thalmann who was in utility finance for 25 plus years. He went to CEOs of utilities companies and said, who do you use for your gas turbine? Who do you use for your specialty contracting? What are the construction companies that you use? And got on the ground perspective on the types of companies that they use as their vendors, and then went about sort of reconfiguring and reverse engineering the index based on where those companies sit in the GICS framework, what industries they live in, which sectors that they live in. And importantly, when you zoom out and look at ELFY, it owns the companies who stand to benefit from rising electricity demand, in some ways driven by AI, data centers, but also by the trends we just talked about. And so what we believe ELFY does to client portfolios is provide a type of diversification and a play on the secular trend that is going to be critical over the course of not just the next 5 years or 10 years, but the next 20, 25 years. So you've got 18 different industries, 5 different sectors, 40% or so of the portfolios in utilities. You've got materials, energy, infrastructure names in there, all companies who were picked as a result of where they fit in this electrification infrastructure build out. And that's the anchor. And you can, as we can talk about, add exposure, juice up exposure to different components of the story, depending on what your objectives are.
Well, let's just get into that now, because again, I pulled a number of different ETFs here. I guess let's stay on the potential AI infrastructure play story. And there's another ETF under the ALPS umbrella, the Alerian Energy Infrastructure ETF, ticker ENFR. How would you describe that ETF's positioning versus what's held in ELFY?
Yeah, so ELFY does have exposure to energy infrastructure companies. That's the main energy exposure that it has in the portfolio. But when you think about energy infrastructure, so these are just the pipelines, the storage, the processing facilities for natural gas and crude oil. And ENFR has about 70% of the revenues that come from natural gas related activities. So think the pipelines that ensure natural gas produced in the United States gets to where it's consumed, which has historically largely been utilities. It's increasingly being liquefied and shipped abroad to emerging markets as well as Asian and European markets. But crucially, we've already seen headlines, Nate, where an energy infrastructure company in ENFR has been tasked with building a small pipeline to get hooked directly up to a data center, who went out and bought a GE Vernova or Mitsubishi or Siemens gas turbine. They've basically said, we're not going to deal with the grid. We're not going to deal with the local utility. We're going to do a quote unquote behind the meter deal where we're going to have access to reliable electricity by virtue of a natural gas pipeline. And so energy infrastructure has become part of the AI infrastructure story directly, but also more broadly, 42% or so of our electricity generation in this country comes from natural gas. And so it is not just important here and now, but it's also important as we try and bridge to this future where electricity demand growth outpaces what we've seen over the course of the past 25, 30 years. And we need everything everywhere all at once in order to solve it. So ENFR, to your point, it juices up your exposure to the energy infrastructure segment of this theme. It typically has a high yield relative to other segments of the market. So let's say you're a yield conscious investor who wants to play on this theme, but can't sacrifice yield in order to achieve it. ENFR is a way to enhance your exposure to the energy infrastructure segment of the theme, but also generate strong relative yield as well.
Okay, so ELFI, ENFR, that hits on the infrastructure side. As we were discussing earlier, another way an investor might attempt to position around AI is to actually invest directly in commodities and natural resources. And I'll point out two ETFs here. So there's the USCF Summerhaven Dynamic Commodity Strategy No K1 Fund, ticker SDCI, which ALPS is a distributor on. And this holds commodity futures. And then there's also the ALPS Core Commodity Natural Resources ETF, ticker CCNR, which holds equities. Do you want to briefly touch on those two?
Yeah, so SDCI is a really interesting product. You look at all of the basket commodities products, which SDCI is over the course of the past 3 or 5 years, and it's been either the top performer or top decile performer, largely because instead of the BCOM or the GSCI, the widely followed benchmarks in the commodity space, it doesn't wait on production or on liquidity as those index tend to do. It just looks every month at the 14 of the 27 commodities in the universe that have the best term structure. So think backwardation versus contango without going too far in the rabbit hole. That tends to be a signal around near-term supply and demand dynamics. And so SDCI gives you basket commodities exposure to the commodities that have, at least in the near term, the best setup from a term structure perspective as a result of perhaps supply and demand dynamics, and also avoids some of the commodities whose setup isn't as attractive near term. CCNR, the global natural resources strategy, is an actively managed basket of global natural resources companies. And so when you think about all of the companies who are tasked with refining, exploring for, producing all of those raw materials that are going to be so critical to this infrastructure build out, this explosion in investment in infrastructure globally to meet rising electricity demand needs, to ensure that AI demand is accommodated, those are the companies at the core of that. And the team at Core has been running strategies like this for decades, has a ton of experience in the category. And again, when you think about ELFI as an anchor, it has exposure to materials companies, some of which are in CCNR. It has exposure to energy infrastructure companies, but you can juice up your exposure to the raw commodities themselves. You can even take it a step further, for example, Nate, with a product like ZSB, which USCF also offers, which focuses specifically on the metals that go into battery manufacturing. And we've seen an explosion in storage applications as a way to augment wind and solar, or perhaps at other data center projects. And so enterprise level storage installations mean more pressure on the commodities that go into them. And so you can sort of see, I can see the wheels turning in your head where you're thinking about taking the anchor of ELFI, which provides comprehensive exposure to the theme, and then juicing up certain categories, whether it be the raw materials themselves, whether it be the energy infrastructure component or other components of the story.
It's so funny you mentioned ZSB because I told you I was looking at a lot of different ETFs and that one jumped out at me. That's the USCF Sustainable Battery Metal Strategy Fund. And to your point, if you want to get even more niche on your commodity plays, you could look at an ETF like ZSB. So I think it's great you mentioned that one. What about nuclear and clean energy? So I would assume these are getting a lot more attention now as people recognize that we do need to ramp up energy capacity and production. But at the same time, there might be some environmental concerns around how we do that. And again, there are two ALPS ETFs I'll ask you about here. So the ALPS Clean Energy ETF, ticker ACES, great ticker symbol, and then the ALPS Nautilus SMR Nuclear and Technology ETF, ticker SMRF. How might these areas benefit from the growth in AI?
It kind of builds on this whole concept of ensuring that you've created a durable, multifaceted mosaic of exposures to capture this overall theme. And ACES is a multi-thematic strategy. So North America focused, you've got everything from wind to solar to hydrogen, geothermal. And what's interesting about the ELFI index is the guy who created it, Mark McLean, who's become a good friend of mine, given that we work so closely together on the ELFI strategy, built it not because of the AI data center explosion, but because of renewable portfolio standards. When we got out of the Paris Accord in Trump 1, one of the things that states responded to that with was building their own renewable portfolio standards. In fact, 32 of the 50 states, including District of Columbia, have implemented these renewable portfolio standards, which is forced spending to decommission fossil fuels and invest in wind, solar, and other renewable sources. And so ACES and some of the companies in ELFI, which are represented in both portfolios, allow you to focus on some of the beneficiaries of that forced spending and the massive investment that's happening in the renewable energy category, which also, by the way, is likely to benefit from this refocusing by countries on ensuring that they have access to reliable sources of power and electricity, which of course you can't necessarily go to war and prevent the sun from shining or the wind from blowing, which in theory creates a moat, at least geopolitically, around some of these renewable energy sources. On the nuclear front, I mean, you hit the nail on the head. This is a category people are really focused on. There's real momentum from a policy perspective around re-implementing and this quote unquote renaissance around nuclear energy. And SMRF was designed to target specifically the companies focused on small modular reactors, this new wave of technology that's designed to be smaller in size and adaptable to the project that it's supporting. And so if that's a data center that has a small modular reactor hooked up, so be it. Well, there is some nuclear exposure again in ELFI, but if you're looking to just juice up your nuclear exposure and capture this theme long term, SMRF was designed specifically to do that. And it's unique from some of the other strategies in the category because of its focus on the SMR category. And importantly, its implementation of some technology layer in the portfolio that gives you exposure to companies who are actually implementing the technology that's going to unlock the ability of SMRs to be applied at scale domestically and internationally.
So, Paul, just a few minutes left here. I'm going to take a step back. We've talked electrification and AI infrastructure, commodities and natural resources. You just covered clean energy and nuclear. I think you'll like this. I think the only area we haven't yet touched on is REITs, because we do need these AI data centers. And so I thought to round out our conversation, I'm going to mention the ALPS Active REIT ETF, ticker REIT, perfect ticker symbol. And if I look at the top holdings there, which I know you're intimately familiar with, but this does have a number of data center REITs. So do you want to quickly touch on that ETF?
Yeah, so the REIT segment's been out of favor for the course of the past, let's call it 4 or 5 years. This has just not been a cycle for the REIT sector. It's woken up a little bit here in 2026. But I think what a lot of people don't understand about REITs is it's not your grandfather's REIT sector, right? A lot of the exposure you get in a REIT portfolio is not office. It's a lot of these emerging diversifiers from a REIT perspective. So data centers certainly are part of that category. Cell tower REITs are also a big part of the REIT category. And I think people underestimate how important a role data center and perhaps even specifically cell towers play. Because if you're, Nate, out and about and you're not connected to Wi-Fi and you're trying to enter a prompt into ChatGPT or Claude or whatever LLM you use, that has to ping a cell tower to then get routed to a data center. And so in many ways, the REIT complex plays a really important role in the AI ecosystem, especially on mobile, where a lot of people access their LLM. And so REIT is actively managed by a guy named Nick Ternora and his team. They've been in the REIT space forever. They're truly experts in it. They live and breathe this stuff. And it's a space where we do feel that SPIVA's on your side, meaning outperformance is possible above and beyond the benchmark with a good, repeatable, durable process.
Paul, before I let you go, we've obviously covered a lot of ETFs here, which I have to say, I'm not surprised, but your knowledge of these and your ability to speak to these off the cuff is remarkable. But how should investors think about incorporating these into a portfolio? You mentioned LFI is sort of an anchor, and then you can juice up or down or around that. But I guess I would just say realistically, investors probably are not going to allocate to all of these, right, as much as you would love them to. And so how do you think investors should approach these sort of ancillary or alternative AI trades?
Well, I think one of the things people think about with themes, and we've been conditioned over time, I think, because themes come and go, to think about them as satellite positions around the core. Maybe they're tactical, maybe they're cyclical. This theme, this electrification theme in our eyes is secular. And because of that underrepresentation at the index level, in the sectors and industries where a lot of the companies that stand to benefit from this investment sit, we believe something like LFI is actually part of a core allocation. And so thinking about it as an anchor, we truly believe it's an important diversifier in terms of your core equity allocation within an asset allocation framework. Then when you start to build and layer on specific exposures, those tend to be edge cases in a portfolio construct. If you're looking for, say, an income-oriented asset allocation framework, ENFR, AMLP, energy infrastructure, because of the yields on offer in that category historically, can achieve a couple goals. They can help enhance the yield of your asset allocation, but also give you some exposure to some of the piping that is important and necessary as part of the infrastructure to support rising electricity demand. As it relates to commodities, we've always believed commodities are a diversifier. You look at the correlation to the S&P 500, to the ag. Historically, it's been very low, and certainly it's been the type of correlation you want in periods like we're going through now, where commodities markets are very fraught in terms of supply and demand, and people don't typically have an asset allocation that's inclusive of commodities. So making the case for commodities as a structural allocation and asset allocation framework, but also which benefits from some of these dynamics related to the electrification infrastructure build out, as well as overall infrastructure spending globally.
Well, Paul, I have to tell you, excellent insight. Like I said, I always learn something when we visit. So thank you for that. And thank you for joining me this week.
Thanks, Nate. Always a pleasure. Appreciate it.
That was Paul Baiocchi, head of fund sales and strategy at SS&C ALPS Advisors. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I will be joined by Andrew Beer, managing member of Dynamic Beta Investments. So we'll be talking managed futures in the IMGB DBI Managed Futures Strategy ETF. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.